Welcome to the Deep Dive. Today, we're digging into a really interesting conversation you shared with us. It's Lyn Alden on the Monetary Matters Network.
Yeah, that was a great one. She was talking about tariffs and how they could, potentially really transform how U.S. dollar capital flows work globally.
Exactly. So our mission here is to kind of unpack those connections she highlighted between, global trade imbalances, capital imbalances, and then what tariffs might actually mean for capital markets and the dollar itself.
And we should also look for any historical parallels she brought up, see if there are actionable takeaways, and just get a handle on her long-term perspective.
Okay, so first things first. Alden makes this really strong link between the U.S. being the global reserve currency and having these persistent trade deficits. How does that mechanism work, according to her?
Well, her argument is pretty compelling. Basically, the huge global demand for dollars, for reserves, funding, trade settlement, pricing contracts, it creates what she calls an extra bid for the dollar.
An extra bid. Okay, so that makes the dollar stronger than it otherwise would be.
Precisely. And that strength makes U.S. manufacturing less competitive on the world stage, even against other developed countries, not just, lower cost emerging markets.
Right, so it's not just about labor costs or anything. It's the currency itself acting as a headwind.
Exactly. And this leads to this continuous outflow of dollars needed to satisfy that global demand.
And she points out this creates winners and losers right here in the U.S., doesn't it?
Yeah, definitely. Think about Washington, D.C. and its global influence, or Wall Street, which thrives on these massive international dollar flows. Tech and healthcare sectors, too, may be less directly exposed to that global price competition.
Mm-hmm. Versus, say, traditional industry,
Mm.
the Rust Belt areas, which feel that competitive pressure much more acutely because of the strong dollar.
That's the dynamic she lays out, which brings us to tariffs as a potential quote-unquote solution. President Trump's view was often framed as other countries cheating at trade.
Yeah, that was definitely the rhetoric. But Alden's point is a bit deeper, isn't it?
Right. She argues that even if, hypothetically, you could wave a magic wand and stop any perceived unfair practices elsewhere, the U.S. would still face these trade headwinds simply because the dollar is the global reserve currency. It's artificially strong due to that role.
And she adds other layers too, right? Like our specific healthcare costs, maybe skills gaps in the workforce. It's not just the dollar, though that's a big structural piece.
Absolutely. It's a complex picture. Other countries have built up real expertise, so her view is that tariffs don't really address that fundamental issue of the dollar's global role. It's sort of attacking the symptom, maybe.
Okay, so it's not the root cause fix. This then gets into the whole weaker dollar debate. There seem to be mixed signals coming from the administration at the time.
Yeah, Trump himself often voiced concerns about other currencies being unfairly priced, which Alden kind of decodes as basically wanting a weaker dollar to make U.S. exports cheaper.
That's the standard playbook, make exports more competitive.
Right. But then, as Alden noted, you also had forces within the administration that seemed to want to attract foreign investment into U.S. assets. A rapidly falling dollar wouldn't necessarily help with that. Maybe things like stable coins or long-term bonds fit that view.
So, bit of a push and pull there.
Right.
But Alden's assessment was what? That a weaker dollar was probably the main goal for many.
Yeah, that seemed to be her read on it, that a weaker dollar was likely desired by, well, a significant part of the administration.
Okay, let's connect this to the other side of the balance sheet, the capital account. Trade deficits mean dollars flow out.
And the capital account shows how they flow back in. Usually, foreigners take those dollars and buy U.S. assets, treasuries, stocks, real estate, you name it. So a trade deficit usually means a capital account surplus. They balance.
But Alden raised a really interesting point here about where those dollars might go in the future.
Exactly. What if those dollars flowing out don't automatically come back to buy U.S. assets? She used the example of, say, China, instead of just buying treasuries, maybe starts making more loans directly to other countries around the world in dollars.
So the recycling mechanism changes. What would that mean then if the trade deficit shrinks? Maybe because of tariffs, but the capital doesn't flow back as strongly.
Well, that's the potential downside Alden highlights. It could lead to weaker performance for U.S. assets, stocks, bonds, the whole lot. A smaller trade deficit doesn't automatically mean boom times for Wall Street if the capital flows change.
That's a crucial distinction.
Right.
And it ties into maybe prioritizing Main Street over Wall Street, perhaps. Political calculation.
Potentially. The idea might be that the goal was broader economic rebalancing, even if it meant, less fuel for asset price inflation. And Alden herself had been saying for a while that something needed to be done about the trade imbalance. It clearly resonated with voters.
Yeah, there was a sense that the status quo wasn't working for everyone. But the timing of tariffs is tricky, isn't it? Alden flags this mismatch.
Oh, definitely. The negative effects of tariffs, higher costs, supply chain disruptions, they can be felt almost immediately.
Whereas the potential positive effects, like reshoring manufacturing, building factories, training workers, that takes years, maybe even decades.
Exactly. It's a massive undertaking. You need the physical facilities, yes, but also automation, skilled labor, the energy infrastructure to power it, entire supply chains need rebuilding. It's not quick.
She had that analogy, like slamming the emergency brake in the highway.
Yeah, a sudden jolt with potentially messy consequences right away. And those consequences can feed back in weird ways. She talked about the U.S. showing emerging market-light behavior. What's that about? What she means is, because there's so much dollar debt held globally and foreigners own so many U.S. assets, a sudden shift maybe triggered by tariffs or trade uncertainty could lead to capital outflows from the U.S.
So money leaving U.S. markets.
Right. Putting downward pressure on U.S. assets, kind of like you sometimes see in emerging markets during a crisis.
And in that scenario, bonds might not be the safe haven people expect.
That's her point. Instead of a simple rotation from stocks to bonds, you might just see capital leaving both, pushing down prices across the board.
Which obviously hits U.S. businesses hard.
For sure. They get squeezed by higher tariff costs. Maybe they can't pass it all onto consumers immediately, so margins shrink. And they can't just snap their fingers and move production back to the U.S. overnight. It's a tough spot.
Okay, let's zoom out again. The long-term debt cycle. Alden has a specific framework for this, right?
Yeah, her view, broadly speaking, is that we shifted from a private debt peak around '08 to a situation where sovereign debt is now the big issue. Fiscal deficits are large and growing, especially with demographics and interest costs.
And dealing with that is politically really, really hard. Austerity, big tax hikes.
Very difficult. Alden argues that traditional methods are tough to implement in the U.S. context. Things like austerity or even big tax increases, including tariffs, which act like a tax, can slow the economy short-term, potentially even hurting future tax receipts. She contrasted it with, say, Germany or Canada, who tackled debt but had maybe less financialized economies at the time.
So our highly interconnected financial system makes those standard fixes more painful or less effective.
That's the idea. Which leads to her view that a significant reduction in the U.S. fiscal deficit is unlikely, really, before the 2030s. Just kicking the can down the road, basically.
And that debt backdrop matters when you start imposing things like tariffs. Now, what about the argument that the country with the trade deficit has the advantage in a trade war?
Right. The logic being they buy more, so they can hurt the other side more by not buying.
Does Alden buy that?
She adds a crucial nuance. She thinks that might be true against smaller, highly dependent trading partners, but against a major rival like China, less clear.
What is that?
Well, China has a huge domestic economy. It's not as reliant on U.S. exports as some might think. Plus, as a creditor nation, China has built up massive financial reserves from years of surpluses. That gives them financial firepower.
And Alden sees U.S. financial markets as maybe a vulnerability here, an Achilles heel.
Potentially, yes. If global capital flows shift away from the U.S., that could be painful, which might explain why the U.S. strategy seemed to involve trying to build a coalition with other countries against China, rather than just going it alone.
Makes sense. So what were the likely U.S. goals regarding China in all this? A stronger yuan, more balanced trade.
Alden speculated along those lines. A stronger yuan would help U.S. competitiveness automatically, more neutral trade terms generally. But she stressed, again, you can't just flip a switch and eliminate the deficit overnight, that emergency brake issue.
So her take was that the tariffs were more like an opening move.
Yeah, likely the opening volley of negotiation, as she put it, the start of what could be a very long process of trying to rebalance things, not an instant fix.
Okay, so if it's not an instant fix, what's the impact on the economy? Inflationary, stagflationary.
Alden's starting point is that you generally need money supply growth for sustained high inflation.
Okay.
So yes, tariffs on Chinese goods would likely cause near-term price increases for those specific items. That's inflationary pressure. But if the tariffs slow down the overall economy and maybe weaken asset prices, you could actually see disinflation in other areas. Demand falls, prices soften elsewhere.
So competing forces. What about the stagflation risk? That's the nightmare scenario, right? High prices, low growth.
That's the big worry. Alden outlined how it could happen. Tariffs mess up supply chains, causing costs to rise. Then, if the government is running big deficits and the Fed steps in to monetize that debt, basically, more QE, you get the toxic mix. Money printing combined with supply constraints, that's your stagflation.
Let's make it concrete. Apple, heavily reliant on China. What happens if you slap, say, massive sustained tariffs on goods from China?
Alden sketched out a pretty grim scenario for a company like that. If you had, say, hypothetical 125% tariffs sticking around, Apple would face really hard choices.
Right.
They'd probably have to jack up prices on iPhones, Macs, everything. That could hammer demand, meaning lower sales, and their profits would almost certainly take a big hit. That's stagflation hitting a specific company hard.
Could they just, assemble somewhere else, route around it, China via Vietnam, that kind of thing?
That's a possibility. Alden thought the administration might tolerate some of that, maybe to lessen the immediate economic shock. But they could also try to crack down on his workarounds. It just shows how complicated it gets.
And she was already a bit cautious on Apple, wasn't she, even before this latest tariff talk?
Yeah, partly due to its high valuation as a growth stock, combined with what she saw as this significant tail risk tied to its China supply chain dependency.
So the tariffs are what did she call it, an instant tax increase?
Pretty much. A multi-hundred-billion-dollar instant tax increase, effectively hitting U.S. consumers and businesses. And shifting those supply chains isn't quick or cheap. It takes years.
And the pain gets shared, presumably, between consumers paying more, Apple's profits, and the Chinese suppliers losing business.
Yeah, it's likely a hit shared across all three. It's not just one group bearing the entire burden.
How widespread is this exposure in the U.S. stock market? Is it just the big names like Apple?
Alden thinks the exposure is probably quite high, actually. Even for companies that don't sell much directly to China, many rely on components from China for their own production processes.
Ah, so it's embedded deep in the supply chain.
Exactly. And beyond that direct exposure, if tariffs lead to a broader economic slowdown, that's going to hit demand across many sectors, even those with no direct China link.
Okay, let's flip it. What's the impact on China itself?
Well, Alden made an important point. While U.S. exports are significant for China in dollar terms, they're actually a smaller percentage of China's total global exports than many people realize.
Interesting. And China's exporting other things now, too.
Yeah, she highlighted their emergence as the world's largest auto exporter, for instance. The bigger risk for China, she argued, is that exports act as a sort of release valve for their economy, especially given the ongoing issues in their real estate sector.
So tariffs hurt them, but maybe don't cripple them. And they can find other markets.
It seems that way. Tariffs will definitely clip their growth, but routing exports elsewhere is possible, which, again, explains why the U.S. might need that coalition approach to have a bigger impact.
Right. The U.S. market alone isn't enough leverage. Did Alden have a view on Chinese stocks amidst all this?
She mentioned she'd previously been somewhat bullish, but had paused that view, waiting for more clarity on how the tariff situation plays out. And there's a second-order risk, too. If tariffs slow down global growth, that hits China's other trading partners, which then indirectly impacts China as well.
It's all interconnected, isn't it? In this kind of uncertain environment, what about assets like gold or Bitcoin?
Alden sees them as global assets that could hold up relatively well, especially if we see capital repatriation from the U.S. They're less tied to one specific national economy.
But Bitcoin has often tracked tech stocks, like the Nasdaq Q, hasn't it? Driven by liquidity.
It has, historically. Alden acknowledged that link, likely due to shared liquidity drivers, but she outlined a scenario where they could decouple.
How so?
If you get tariff-driven stagflation, that could really hurt Nasdaq Q company margins and earnings. But if overall liquidity in the financial system stays high, maybe due to Fed actions, Bitcoin might hold up better or even rise while tech stocks suffer. It's a specific scenario, but plausible.
And her positioning, still holding gold.
Yep, she mentioned holding gold as a defensive asset, kind of instead of bonds in this environment. And she views Bitcoin's risk profile as more akin to an equity holding.
What about bond yields then? If things go south economically, would they plunge as usual?
Alden's take is, maybe not as much as people expect. She doesn't necessarily see them spiking uncontrollably, but thinks they're unlikely to fall dramatically either, which limits their usefulness as that traditional safe haven diversifier.
Why wouldn't they fall much in a slowdown?
Well, persistent deficits, potential inflation stickiness, plus the unpredictable risk of, say, a large holder like China deciding to sell treasuries that could put upward pressure on yields even if the economy weakens. Her base case was more like choppy, range-bound yields.
Okay. What about the rest of the world? How do other countries fare in this?
Generally, slower global growth is bad news for most countries. It's hard to escape that.
But maybe some are better positioned.
Potentially. Alden suggested that many foreign markets might have some built-in protections simply because their starting valuations are lower than in the U.S. Less froth to come off, you know?
Right, the valuation matters.
Exactly. But ripple effects are unavoidable. She used that Costco example. Costco might be a defensive company, but if its stock is priced for perfection, it might not be a defensive investment. Valuation is key.
And how quickly can companies actually change their supply chains? Is it elastic?
Initially, probably not very. Alden expects companies to adopt a wait-and-see approach first, given the uncertainty. Nobody wants to make huge, costly changes if the tariffs might be temporary.
But longer term?
Longer term, there's more elasticity. If tariffs look permanent, companies will move supply chains either back to the U.S. or, perhaps more likely, to other countries like Vietnam, Mexico, India. But it's expensive and takes years. Plus, think about the energy needed if U.S. heavy industry really ramps up. That's another constraint.
Could tax cuts or deregulation offset the tariff drag? That was often part of the policy discussion.
Alden's assessment was that the scale of the tariffs, as they stood or were proposed, represented a pretty significant net tightening of fiscal conditions. Any likely tax cuts probably wouldn't be large enough to fully offset that drag.
So the political messaging might be stimulus, but the net economic effect could be tightening.
That was her read on the numbers. And beyond the direct fiscal impact, just the uncertainty itself tends to tighten financial conditions.
How so?
Businesses delay decisions, investors take less risk, banks might tighten lending standards. It's a bearish factor in itself. And if there isn't offsetting monetary loosening from the Fed, the base case leans towards slower growth, maybe even recession.
Alden mentioned selling volatility as a strategy she uses. Can you unpack that a bit?
Yeah, she clarified she does it in an unlevered, conservative way. Selling cash secured, puts on stocks she'd actually be happy to own if the price dropped.
So she collects the premium, and if the stock falls below the strike price, she gets assigned the shares, effectively buying them at a discount.
Exactly. She sees it as collecting income and potentially buying the dip systematically. But she was careful to warn about the risks, especially with leveraged volatility strategies, which can blow up spectacularly.
Right, definitely not for everyone. Thinking about the bigger picture, how historically significant does Alden think these events are? Is this a major turning point?
She suggested it depends on how long these shifts last. But her leanings seem to be, yes, this is likely a pretty significant transition.
Why? What makes it different?
Mainly because of the sheer scale of global capital concentrated in U.S. markets and the large structural nature of the trade deficits that built up over decades. It feels like imbalances that have reached a point where something has to give, maybe more impactful long-term than, say, the market jitters we saw in late 2018, which felt more temporary.
And if tariffs do succeed in lowering the trade deficit over time, what does that mechanically mean for capital flows in the dollar?
Well, if the trade deficit shrinks, by definition, fewer dollars are flowing out. Assuming the capital account adjusts, that means less foreign capital flooding into U.S. markets, and less demand for dollars globally could lead to a weaker dollar over time. That's the mechanical linkage.
She also proposed an alternative path, didn't she? Rather than just tariffs, maybe encouraging a more multipolar currency world.
Yes, that was a really interesting point. Her idea was that actively allowing or even encouraging other currency blocks to form more use of the yuan in China's sphere of influence could actually be a more effective, maybe less disruptive way to reduce the dollar's structural overweight and thus the U.S. trade deficit compared to just using tariffs while trying to maintain dollar dominance.
That ties right back into the Tariff dilemma, doesn't it? The core conflict of being the reserve currency issuer.
Exactly. The trade deficit is almost the necessary offset for providing the world with its reserve currency. Alden feels this fundamental dilemma isn't acknowledged enough by markets or politicians.
And she connects this to history, drawing parallels with past empires in her book, Broken Money.
Right. She references Chapter 13 talking about the historical pattern. Empires overstretch their commitments, things become unwieldy, and often monetary debasement follows as a way to manage the impossible math.
But she doesn't see a single successor to the dollar, necessarily.
No, her base case isn't for, say, the yuan to just replace the dollar. It's more likely a shift towards a more multipolar world, where several currencies play significant regional roles, and neutral reserve assets like gold and maybe Bitcoin become more important on the sidelines.
And could that actually be good for parts of the U.S. long term?
She thinks so. If managed skillfully, a rebalancing could benefit the U.S. industrial base and potentially the average American worker, but it depends how the pullback happens.
What are the options there?
She framed it as two paths. Empires can pull back intentionally, trying to minimize harm and manage the transition gracefully, or they can fight every perceived challenge, trying to maintain dominance everywhere until they eventually exhaust themselves. The choice matters hugely.
Shifting gears slightly, what about the Fed in all this? How do tariffs complicate their job?
Hugely. Alden emphasizes we're moving into a more fiscally dominant environment where government deficits and debt are major drivers. The Fed's job gets much harder. Tariffs could be inflationary, raising costs, or deflationary, recessionary, killing growth. What do you do then?
Stuck between a rock and a hard place, could it threaten their independence?
Over time, potentially yes. If the Fed is increasingly seen as needing to accommodate fiscal needs, its perceived independence could erode. She suggested watching the Fed's balance sheet closely, especially for any signs of involuntary actions, like having to step in to stabilize the Treasury market if buyers disappear.
And monitoring the Treasury's cash balance, the TGA.
Yeah, that's another key indicator of government funding flows, her base case. Maybe slightly lower rates a year out, but uncertainty is extremely high.
What about the really dramatic scenario, a sudden widespread dumping of the dollar globally? How likely is that?
Alden put the probability as low, but maybe slightly higher than usual, given the somewhat confrontational approach on trade and the dollar's role.
But not her base case. Why not?
Because the demand for dollars is still incredibly sticky. Think of all the dollar-denominated debt globally that needs servicing. Plus, huge amounts of dollar assets are held by foreign governments and private entities. Unwinding that quickly is incredibly difficult and disruptive for everyone, not just the U.S. The network effect is powerful.
So, more likely, a gradual shift, maybe with some shocks along the way.
That's her expectation. A process unfolding over years, maybe decades, similar to how past global currency shifts have happened. And she stresses the difference between the level of the dollar, its exchange rate, and its overall relevance in the global system. The relevance might decline gradually even if the exchange rate stays relatively strong at times.
Okay, last big question on positioning. Alden still prefers foreign stocks over U.S. stocks.
Yes. Over a medium-term horizon, say the next 3-5 years. Her reasoning includes the potential for ongoing turmoil in U.S. markets due to these shifts, changing capital flows, the valuation differences we talked about, and policy uncertainty in the U.S.
Even though U.S. stocks might have periods of outperformance?
Sure, short-term counter-trend moves are always possible, but for the longer strategic allocation, she sees better risk-reward elsewhere. Partly just as diversification against the risk of the U.S. market entering a prolonged stagnant period, like we've seen historically in other dominant markets after periods of excess.
Wow, okay. That was a really comprehensive dive into Lyn Alden's thinking on tariffs and their potential shockwaves.
Yeah.
It all started from that Monetary Matters interview you flagged. We've covered a lot of ground, from the mechanics of the reserve currency
to the trade deficits, the role of capital flows, the complexities and timing issues with tariffs, potential impacts on assets like stocks, bonds, gold, Bitcoin. It's intricate stuff.
Key takeaways for me are definitely that structural link she makes between the reserve currency status and the trade deficit that's fundamental. And also how disruptive tariffs can be, maybe not solving the root problem and pushing us towards a more multipolar financial world potentially.
Absolutely. And the potential for stagflation if things go wrong, that's a risk to keep in mind. Plus, the idea that even safe havens like bonds might not act as expected in this kind of environment.
Were there actionable insights we pulled out? Diversification seems key.
Definitely. Diversifying across asset classes and geographies seems crucial when facing this kind of uncertainty. And for investors comfortable with the risks and mechanics, her point about selling volatility conservatively, like those cash-secured puts, could be interesting as a way to generate income or potentially buy favored assets cheaper.
And for anyone wanting to go deeper, you really should check out Lyn Alden's book, Broken Money. It lays out a lot of the historical context and the structural arguments in fantastic detail.
Yeah, highly recommended. And of course, watch the original interview itself on the Monetary Matters YouTube channel to get the full picture directly from her.
And we absolutely have to thank NotYourAdvisor.com for setting up this AI review. It's been incredibly helpful in processing this. Definitely subscribe to their channel for more great content like this. So we hope this deep dive has offered a clearer perspective on these really critical global economic forces at play. What stands out most to you listening? What other questions does this raise? It feels like this is just the beginning of a much larger conversation, doesn't it?